Hi, my name is Griffin Bridgers. I'm a tax and estate planning attorney with the law firm of Hutchins & Associates in Denver, Colorado, and it's my pleasure to introduce what estate planners need to know about the Build Back Better Act. This presentation is intended to cover tax legislation which was proposed on October 28, 2021, which may replace some previous proposals which came out and were published on September 13th of 2021. As a reminder, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only, so you cannot rely on this for advice. You need to consult with an attorney or tax advisor. So here's a quick timeline of where we've been and where we might be going. So, as many people are aware at this point, on September 13th of 2021, the House Ways and Means Committee released a summary of tax proposals which were intended to raise revenue for certain infrastructure proposals that Biden had floated. And around that time, Chairman Neal also released a statutory framework, a bill proposal for the tax proposals and the text of the law that might have been enacted. So a lot of this caused panic, especially for estate planners, because there were two very sweeping changes in that old proposal. One is a change to the tax treatment of grantor trusts, so that transfers to them after a certain date could have been disregarded for estate, maybe for gift tax purposes. There was also a proposal to accelerate the sunset of the basic exclusion amount. The basic exclusion amount, which is currently $11.7 million, will be sunset by one half in 2026, pending future legislation, but the proposal of September 13th would have pushed up that effective date of the one-half reduction to 2022. Now, there's a new proposal. There might be good news here. We just don't know. But I'll talk about what some of that good news could be and how it might affect planning going forward. So on October 28th of 2021, new text for the Build Back Better Act was released by the House Rules Committee. Now, for the time being, in this new text, both the grantor trust proposal and the reduction of the applicable exclusion amount have been removed, removing maybe some of that panic that we've been worried about for the past 6 weeks or greater. Now, there are still some proposals which estate planners and tax advisors should know about which could affect trusts and estates. And those are what I'll cover in today's presentation. So here's a quick overview and summary of what we're going to talk about. For one, there might be a new high earner tax starting in 2022 on which income retained in a non-grantor trust could be subject to an additional income tax of 5% on income over $200,000 plus an additional 3% on income over $500,000. So combined, that could essentially mean income over $500,000 is subject to an 8% additional tax. It's not clear how that's going to work yet, but that's one proposal. Another affects the treatment of qualified small business stock held by a trust or estate. So for sales or exchanges which are binding and occur after September 13th of 2021, the 100% or 75% gain exclusion has been removed for all trusts and estates. Instead, you can only exclude up to 50% of the first 10 million of recognized gains on sales of QSBS stock or exchanges of QSBS stock by a trust or estate. Finally, there's an expansion of the net investment income tax, in which that tax may also apply to undistributed income of a trade or business within a trust or estate. We'll look at each of these in turn, but for the time being, a quick stop sign is that there is, for the time being, no change to the existing tax treatment of grantor trusts and no change to the basic exclusion amount. This could be the good news, but I want to caveat that this does not mean that these proposals are dead. They could find their way back into the bill, but for the time being, it's looking more and more like, at best, these proposals are now on life support. But don't rely on my representation here as a reason to not take any action. You still want to be conscious of the fact that anything could happen. But for the time being, We'll dive into each of these proposals in turn. The high earner tax applies to both individuals and to estates and trusts. We'll cover the individuals in a second, but for the time being, for an estate or a non-grantor trust, for tax years starting in 2022, so there's no immediate need to act here, but starting in 2022, you need to be conscious that there could be an additional high earner tax of 5% on undistributed income over $200,000, and then 3% additional on undistributed income over $500,000. So when you combine this, this can create up to an additional 8% tax on trusts for income over $500,000 in and beyond 2022. So what should you do with respect to trusts that may fall into this high earner status? For one, if you were looking at grantor trust proposals before and were planning to possibly terminate grantor trust status, it may be important to pump the brakes on that, especially for any pending liquidity events that could close before the end of 2021 or even in 2022, because terminating grantor trust could open up the trust to this additional up to 8% tax unnecessarily. If you do have any pending liquidity events, it might be important to look at closing those before the end of 2021 as well, especially for non-grantor trusts, because that could cause additional income tax on that liquidity event as well. Now, for trusts starting in 2022, which could be subject to this tax, some things you may want to consider are distributing D&I to beneficiaries on an annual basis, more so than you might have done in the past. And also maybe looking at capital gains and considering allocating those to income instead of principal and distributing the capital gains as well, because that can take you under those thresholds for the trust, the $200,000 or the $500,000 at which this additional tax might kick in. Now, when you're planning distributions to beneficiaries or even looking at grantor trust status, you need to consider the effect on individuals. You need to note that this high earner tax also applies to individuals, but at much higher brackets. It only applies to individuals over 10 million for joint filers or 5 million for joint filers and filing separate, or I should say married taxpayers filing separate. And then that's for the 5% bracket, and the 3% bracket kicks in over 25 million or 12.5 million. So flowing out D&I shouldn't affect most beneficiaries, but grantor trust status for any individuals with liquidity events pending could be a concern. Now, another big change is for qualified small business stock, which is regulated in terms of tax treatment under Code Section 1202. Currently, QSBS is subject to a partial or full gain exclusion on its sale or exchange, depending on its acquisition date, if held for at least 5 years. Now, there used to be a 28% rate which applied to this, but for now, gains on QSBS stock are subject to the traditional long-term capital gain rate, which may increase and notably isn't part of this proposal, but you still need to be conscious of the fact that that's been a political plaything through this whole tax proposal negotiation process. Now, in any case, and this doesn't change, the acquisition of QSBS typically has to be through original issue of C corporation stock, or through the acquisition of that stock through certain non-recognition transfers over time, where there is a transferred basis. So, currently, for original issue qualifying QSBS, after September 27th of 2010, that's acquired after that date, 100% of the gain on the sale or exchange of that stock can be excluded from gross income up to a maximum of $10 million per taxpayer, which is a loose term. We'll talk about that per taxpayer in a minute. Now, prior to this, and for stock acquired prior to that, only 50% of the gain could be excluded, except for certain issuances which took place between 2009 and 2010, up to the point of the 100% exclusion kicking in. That's a little bit beyond the scope of today's discussion, mainly because what we're going to look at in a minute, that the 75% and 100% exclusion could be going away for estates and trusts. But for the time being, to set the stage, previously Section 1202 didn't really distinguished between taxpayers and notably had no attribution or related party rules between trusts and parties to a trust, which meant under the existing law, you could have leveraged that $10 million exclusion across multiple non-grantor trusts. Obviously, there's a gift tax cost to funding those trusts, but a lot of planning for 1202 stock has taken place in the last few years intended to leverage that $10 million exclusion for a family through the use of non-grantor trusts. Now, the proposal will partially pull the rug out from under this strategy, and unfortunately, this has retroactive treatment, as we'll see. So the new proposal says that for any individual whose AGI, without regard to the sale of the QSBS stock, exceeds 400,000 for the year, then the 50% exclusion will apply. So there's only 50% of exclusion of gain up to the first 10 million of recognized gain. And regardless of a trust or estate's AGI for the year, the 50% exclusion will apply to all sales or exchanges of QSBS by non-grantor trusts or estates going forward. So the effective date will be any sale or exchange which occurs after September 13th of 2021, unless there was a binding contract to sell or exchange that stock in a recognition transaction which was in place on or before September 13th of 2021. So what's the result? Now, just 50% of the first 10 million of gain of a non-grantor trust on the sale or exchange of QSBS stock can be excluded. The other 50% is still subject to taxation at the capital gains rate as long-term capital gain. Now, all gain over $10 million will be taxed at the long-term capital gain rate, assuming it was held for 1 year prior to the sale or exchange as well. So QSBS planning using non-grantor trust isn't dead in the water. So if you've created a bunch of non-grantor trusts to hold QSBS stock, you still get some benefit here. The difference is you can only exclude 50% of that first 10 million in gain from the trust's gross income instead of excluding 100% of it. So there's still some benefit, but some of the teeth have been taken out there. Finally, with the net investment income tax, there is a change where this was in the old proposal and was continued here, where for estates and trusts, the 3.8% net investment income tax is expanded to include undistributed income within a trust or estate from a trade or business. And that applies in addition to that high earner tax we discussed above. Thus, for non-grantor trusts with income over the bracket threshold for the highest ordinary income tax rate, which is currently $13,050, this tax can apply. So what we're looking at here is in addition to the highest income tax rate, which isn't really subject to change here, it could be 37%, it could be 39.6% when this all shakes out, but you're looking at potentially an additional up to 11.8% income tax for retained income in a non-grantor trust for dates starting in 2022. So here's just a quick overview of the effect of new income taxes on trusts. Assuming that there's no changes to income or long-term capital gains rates, potentially 3.8% on undistributed trade or business income over 13,000 and change. You have potentially a high earner tax on retained income within the trust between 200,000 and 500,000, then potentially 8% plus the net investment income tax on income over $500,000 as well. So potentially you have an additional 11.8% income tax, which could apply to non-grantor trusts going forward. So thank you for joining me for this presentation. If you're interested in hearing more and enjoy this type of material, you can receive updates on this and other tax reform and estate planning topics by subscribing to my newsletter at griffinbridgers.substack.com. You can also follow me on YouTube, just search Griffin Bridgers, and if you want to reach me directly, you can reach out to griffin.bridgers@gmail.com. So what do I offer? Well, obviously, I love education and speaking and teaching, so I offer services as a speaker, and I take that more granular, where I offer bespoke tax and estate planning media, or even bespoke virtual education if you might want that for your one-on-one client meetings or internal use for your organization. But thank you for joining me for this presentation. Stay tuned for additional presentations on tax reform. Good luck in this planning environment, and I look forward to seeing you in my future videos and content.